What's up, guys? Your agent Tyler Wehrung here with Keller Williams, and today we're going to talk about analyzing investment properties. We'll talk about a couple of the rules of thumbs that are often thrown around, kind of what those are and how to use them, and then we'll show you how to dig a little bit deeper to run the numbers on deals that you've kind of passed that sniff test. And then lastly, we're going to walk you guys through how we analyze deals in the software that we use to do that. So with that, let's jump in. Alright guys, so first we want to start off talking about the two most common rules of thumb that you hear about, being the 1% rule and the 50% rule. So first, let's talk about what those are, and then we'll show you how you use them. So first, the 1% rule. So 1% rule means that the property must rent for 1% of the purchase price. So the 1% of purchase price equals rent. All right, so for most of the examples that we're going to use today, we'll use a $100,000 house just to be easy on our public math here. So on a $100,000 house, $100,000 purchase price, this property must rent for $1,000 a month. Okay, so that's the premise of the rule. And so if you can kind of reverse engineer it and say, if you know a particular area, the rents there are $1,000 a month, then your max purchase price would be $100,000. All right, so you take the rent and divide it by 0.01 to kind of get what your max purchase price is. Or if you're looking at a house that has a listing price, you take the listing price and multiply by 0.01 and see if that you could get that in rent. Okay, that's the premise of the 1% rule. This is kind of different in every market to see if this actually holds water. So us in particular, we actually use the 1.25% rule. The numbers work better in our market, and we're able to cash flow typically if it meets that test. But again, these are kind of, if you had to get through 100 properties, these are kind of like how you would weed out the 80 that don't make sense. But you would never just buy a deal based on kind of these rules of thumb. It's kind of to get you down to the narrow set so you can take a deeper dive, and we'll show you how to do that here in just a minute. So for the 1.25% rule, same principle, you would take the listing price or your max purchase price, multiply by 0.0125, or you take your rent and divide by 0.0125 to get your max purchase price or max offer. Okay, maximum allowable offer, or MAO, is a common term you'll hear thrown around for this. So that's the 1% rule in a nutshell. The next rule of thumb that's often thrown around is the 50% rule. So 50% rule means that you should assume that 50% of the income on your rental property, so 50% of your rent, is going to go out the door in expenses. So 50% of rent equals expense. Again, this is different in every area. It's different if you're self-managing, if you're buying a brand new property. Obviously, the expenses are going to be low, but in this case up here, we're getting $1,000 a month in rent. You would assume that 500 of that is going to go out the door in expenses, and then the remaining $500 that you have left would be there to service the debt. So if you buy a property or you have a property free and clear, 50% goes out in expenses, and then the other 50% is your cash flow. But the mortgage is not in this, but it does include your insurance and taxes. So depending on how you do PI/TI, for most of your personal residence, that's going to be escrowed, but typically in investment property, you're only going to pay principal and interest as part of your mortgage, and your taxes and insurance will be paid separate. Okay, so those are kind of the two rules of thumb, and they're just that. They're kind of a litmus test, a way to kind of, very quickly see if a deal is going to make sense to you before you start to dig in and do a deeper dive. But now we're going to show you, let me wipe this off, we're going to show you how to dig deeper and kind of what all the numbers are that make up these two rules. Alright guys, so now we're going to test out the 1% rule and kind of show you everything that goes into the 50% rule and see if this deal would make sense, this hypothetical deal. So $100,000 purchase price, we're getting $1,000 a month in rent because it's the 1% rule. So I'm going to talk to you about all the expenses that you have to take into consideration and kind of how to do this next level of analysis. So the first expense that we're going to call out is vacancy. So vacancy is what you should set, or how much money you're going to set aside for when your property does eventually turn and you have to put money in to kind of bring it back up to rental standards. So, these are things like painting, new carpet, new flooring, all the things you would have to do to get your property in rent-ready condition. Okay, so vacancy is typically, most of these expenses are going to be in percentage form. So then you can do the math based on whatever rent you're getting. So vacancy, we typically use 5%. So that approximately comes out to be, a month of vacancy every 1.5 to 2 years is what 5% would get you. And you're kind of putting this 5% off into a separate pot, in theory, that you would use kind of as your fund available when you do decide to turn the unit. So 5% of 1,000 is $50 a month that you're going to be setting aside in vacancy. All right, so the next expense is going to be repairs and maintenance. This is setting money aside for when things do break, and they always do, right? So this is, again, this other pot where you might not do this every month, but you need to have this money sitting there so when something breaks, you do have to replace a toilet, or they call and water's leaking somewhere. This is your money to call the plumber. So repairs and maintenance, when you're doing the 50% rule, the repairs and maintenance is typically 10% of that. So that's kind of how that rolls in. We are typically closer to 6 to 8%. And this will also be property specific. So if you're buying a house built in the 1800s who hasn't had any updates to it in a while, you're probably going to lean towards the 8, 9, 10% there. Where if you are renovating a property when you buy it, or you're buying something that's been built in the last 10 years, you're probably closer to that 6% area. So this is where it's going to be important to you, for you to network with other investors in your area and kind of see what people are paying. And once you have a couple properties, you can kind of see what your numbers look like in your area as well. But for this example, we're going to use 8% or $80 a month that we're going to be setting aside for repairs and maintenance. The next expense is called CapEx, or capital expenditures. So capital expenditures are different from repairs and maintenance in the fact that these are your big ticket items that don't have to be replaced near as often. So these are things like roofs, HVAC, hot water heater, bigger things that have a longer life, but they are more costly when they come up. So you need to always be setting money aside for those so you're not caught off guard, all right? So these are also, I typically keep repairs and maintenance and CapEx pretty close to the same. So for this example, we'll use 8%. But again, the same goes for if you're buying an older property, you might want to hair on a little bit higher. So $80 a month for CapEx. And the next expense is property management. So often we see folks not include this when they're running their numbers because they have the thought in mind they're going to self-manage, which is great for the time being. But if you have any plans on scaling at all, or you want to sell to an investor down the road, they're likely going to include this. So you have to think about your exit strategy here or your scaling strategy. So even though you might self-manage, we self-manage currently, we still include property management when we're analyzing deals so that we're not caught off guard down the road. And we do have money to pay a property manager when we decide to do that. Also, if you're self-managing, you have to value your time. So you need to include this in your numbers, pay yourself for the management work you're doing, and then you won't be, nothing will change when you assign it out to a property manager. It'll just go to them instead, but your cash flow won't change at the end of the day. The pretty common industry standard for property management is 10%. That can change with different asset classes. When you start getting into multifamily, you can slightly lower that and pay per door. But it's pretty typical nationwide for single families to be 10%. So in this case, we're looking at $100 there for property management. All right, the next two are taxes and insurance. So this is where it's going to be more important for you to kind of figure out what these numbers actually are and you stop using these rules of thumb. But just for analysis sake and kind of the quick dirty math, taxes are typically in our area, again, you're going to want to look, wherever you are, they're typically about 1.5% per year. Okay, so if you're looking specifically for your taxes, Google your county and then auditor or treasurer. So those will be two different places where you can find it. The auditor site is typically going to have more information about the specific property, when it was last purchased, things like that, the land use code, all kinds of relevant information about the property. And the treasurer site is about just collecting that property taxes. But either way, and on most sites now, you'll see when we analyze a deal later, even like Zillow, Redfin, Trulia, they will most likely include property taxes on the site as well, but always a good idea to go and check it in the actual county's website just to confirm. But for this example, we're going to use our 1.5% per year figure for taxes, and that kind of comes out to 12% a month, okay? So 12% here, or 120 for property taxes. Insurance is typically 1% per year, or that comes out to be about 8% per month. Again, when you're getting close to actually considering putting an offer, you want to get some real quotes from insurance companies so you're not caught off guard if a property has something unique or an additional dwelling unit on the property, something like that that might jack this number up. So always a good idea to get a quote here. But wow, that is terrible handwriting. So $80 a month there. For insurance. And so those are pretty much your costs when it comes to considering maintenance. And if you'll do the math here, I'm not good at public math, but all these percentages are typically what's included in that 50% rule. So this looks, it's probably about 50% if we were to add all those up. And so that's kind of where that rule of thumb comes from. But it's a good idea for you to know kind of how all those numbers, what that really looks like under the hood, essentially, of the 50% rule. So all right, so now we need to consider what this property might actually cash flow. So the one thing that this doesn't take into place is what your financing is going to be. Because a lot of folks will buy property without debt on it, so this is kind of debt agnostic, a way to figure out what the expenses are going to be on the property. So in this example here, we kind of already have done the math. If you're going to buy a $100,000 house, put 20% down, a loan at $80K, wow, man, those are very horrible handwriting. But a loan at $80K, 5% interest, 30 years is going to come out to be $429, $429 for your mortgage. Keep in mind that is just principal and interest, so if you're used to paying your full PITI, this will be slightly different. So what you're going to do to figure out your cash flow, so if we add all of these up, all of your maintenance here, it's going to be about $510. I've kind of done this math in a little bit of advance. So if we add $429 and $510 together, we're at $939. And you can see you take that away from your rent here, you're only left with a measly $61 in cash flow. All right. So you need to kind of, even when you have good months, you still want to be setting all this money aside, especially, well, really the top three. The other ones are going to come out regardless. But, often we see folks not include these and kind of will tell you that their property is cash flowing $200 or $300 when in fact they're not considering that fact when maintenance is going to come up, when they're going to get a vacancy. So this property cash flows $61 if we're using the 1% rule, which is why we don't use the 1% rule, because everybody's different, but $61 a month isn't really life-changing. It's really not worth the headache of kind of going through all this. We like to see at least $100 to $200 per door that we're going to buy, and that's kind of where our numbers fit in. But you'll want to kind of see what what makes sense for you. So if we take a look at this same deal and we use the example we talked about before, the 1.25% rule, that's going to change this here to $1,250 a month, and we've kind of already done that math. So $1,250 with these same percentages applied is going to bring your current expenses to $629. So this would be $629, and then your mortgage balance doesn't change. It's still going to be that same $80K. So $429 and $629 actually take you to $1,066. That is just horrible. But you have to think now we're getting $1,250 a month. So at $1,250 minus $1,066 is going to get you close to $180 a door. and that's much better. That's a lot closer to the figures that we look for, and that's why we use that number. So you can just see here, if this was a newer property where you could potentially pull repairs and maintenance down to 6%, that's enough to probably get you to the point where you're hitting that $200 a door mark, and where this might actually be a good deal for you to take down. So that's kind of in a nutshell how that plays out, what the 1% and 50% rules are, and kind of how to take that next level of analysis and figure out the math behind the scenes. So at this point, we're going to switch over into a screen share and walk you through how to use software to leverage all this math for you to kind of do that, and so you don't have to, pull out a notebook or a whiteboard when you're analyzing your property. But it's always a good idea to do this a couple times by hand so you know everything that's going into it, and you don't just rely on the software to make investment decisions for you. So I hope this was helpful. Let's jump over to the deal. All right, guys, so we looked at a hypothetical deal on the whiteboard for you to really understand the math, but now let's check out an actual deal using some software and kind of how all those same expenses relate. So we use Deal Check personally, but Bigger Pockets has another good calculator. There's probably some other great ones out there. I'll drop my affiliate link in the description for Deal Check, but I really don't care if you use it or not. It just worked out great for us. So, all right, I'm going to flip my screen over now. You can go out, we're just going to use Redfin, but you can really go out and search for deals anywhere. This is our typical area we buy in, so we're just going to take a look at a hypothetical deal here. Let's see what this one is. All right, 1026 Park Avenue. Let's look, actually it looks pretty nice house. Definitely don't see anything that we need to repair. So let's go ahead and plug it into Deal Check. So I have this up in another tab. So one of the cool things with Deal Check is you can actually, it'll import the data, especially if it's been listed out there before. It will pull all that in from public records, so you don't have to do a lot of this entry. So you'll see here, 1026 Park Avenue. You don't even have to type the whole address, it just starts to flood in. So you can search, pulls in the year it was built, looks like it's searching for some additional information. It pulls, if you want to use the Zillow's estimate, Redfin, they come up with their own rental estimates. So you kind of pick all this stuff here. Okay, yada yada. All right, so you just click import the property. So it pulls that all into kind of their calculator, and it starts running some initial assumptions, but we need to walk through and set these numbers ourselves. So let's see. So we go over to purchase worksheet. We'll just assume here that we're going to pay asking price, so $135. Don't really care about the ARV. At this point, we're going to use financing. 20% down. This is typically what our loans look like, 4.875 at 25. Just to compare it to our deal we did on the whiteboard, we'll go ahead and use 5% 30-year fixed. Purchase costs probably going to be 2. Doesn't look like it needs any rehab, but you can plug all your rehab numbers in here. Gross rent, 867 feels a little low. Definitely doesn't meet the 1% rule like we talked about before. So this will show you rental comps in the area. This is one thing that we actually don't like a lot about Deal Check. I mean, it's pulling things from across the river in totally different neighborhoods. So some of the times you're going to have to know your area and kind of go out and do your own research. Let's just assume, I think we could get $1,000 a month in that. It's a nice house. So let's do that. All right, where am I at here? So we're going to go $1,000 a month. Our 5% vacancy we talked about before. So this just, if we were going to use the 50% rule, this just says, let's assume they'll take a percentage of the rent and use that for expenses. But like we talked about before, you really have to itemize and make sure that this deal is going to check out. So this pulls property taxes in from what was out there in public records, but like I said before, you always want to check that. So I'm going to pull up our auditor site and just do a quick check so you can see how to do this. I have the link saved, but if you just go to property records, search by address. This is 126 Park. All right, so let's see. So taxes were actually $14.70, what they have over here. So actually they were a little more conservative. We always go a little bit higher. As a property owner or as an investor, you're going to pay slightly more taxes than somebody would be owner occupying it. All right, insurance, let's see, that feels a little low. Using our example before, about 1% per year. So I'm going to put this at $13.50 per year. It'll do the math for us. Property management, 10%, like we talked about. This property looks pretty new. I'm going to kind of go in the middle here with 7%. It is an older house, so I like to kind of err on the side of caution. Okay, so that looks pretty good there. I'm not going to do anything with landscaping. You can add additional things here if you are going to pay for certain things. All right, so let's go back. And then once you put in those numbers, you can click this property analysis tool. All right, so it's telling us right away that it's going to actually lose us $102 a month. So definitely not a deal we would like to do. It'll show you kind of how that breaks out. So our operating expenses, those are the ones that we walk through. The itemized expenses are your operating expenses. You can see it puts us right almost at the 50% rule. It'll show you kind of what those are and how that breaks out in a monthly basis. So our NOI is your operating expenses less your rent. And then you take out your mortgage payment there, which would give us that negative $102. So definitely not a deal you want to do. But the cool part about Deal Check is one of the tools we use the most is this offer calculator. So instead of you kind of coming up with trying to figure out how this deal might make sense, it'll tell you based on your criteria. So if we want a cash-on-cash return of 10%, internal rate of return at 30, basically you put in any of your criteria here and it's going to calculate the max offer that you can make or the most you can pay for that property. All right, so in this example, let's just say we want our cash flow to be at least $100. So then it gives you your offer. So my max offer would be $85,000. In order to get this property to cash flow $100. So very cool tool, and you can kind of play with all of these. You can add multiple. So if I want cash on cash return of 10% and $100, it looks like we have to be at 75 as our max offer. But this considers, when you do this offer calculator, it keeps everything constant, as in your rent and expenses. So once you can go back to edit property and say, say you do some more due diligence, you think you can get $1,200 a month in this property, or you get an actual insurance quote and it's much less than you thought. So this is kind of how you play with the numbers. Go back to property analysis. So if we can get that new rent, it does cash flow $40, but then we'll go back to our offer calculator, and based on this, we can pay a max of $100,000. So that's kind of how you leverage technology to do this for you. Also in Deal Check, you can set your template. So if we find out that we're at 49% just about on every deal, you can plug that in, and as soon as you pull a property in, it will already kind of chunk those numbers up for you. So I hope this was helpful, guys, to see kind of how you would actually do this and how all the math plays out. But I recommend you find a good calculator, Deal Check, Bigger Pockets, that you can use. Kind of download a smartphone app so you can chunk these away quickly. The only way to get deals is to analyze them and put offers out there. Even though in a hot market they probably wouldn't take $100,000 on this house, it doesn't hurt to kind of run the numbers and check. And once you start doing this often, you'll start to see outliers. So you might see these cash flow negative. All of a sudden one will jump off the charts and it'll cash flow $200. Or you'll see a property sitting on the market that maybe for a couple months that you can run the numbers on and it might make sense. So always a good idea just to be running numbers and staying on top of what's going on in your market, stay on top of your rental rates and kind of what properties are selling for so you can be able to jump on a deal when you see one. So if this was helpful at all, please like, subscribe, or share it with someone else who might need help analyzing deals or wants to get into rental property investing. But with that, I'm Tyler Wehrung, and we'll catch you next time.